So I caught you at the Future Proof panel with Jan Van Eck, and there was another woman. I should remember her name.
Lauren Goodwin.
She had a lot to say, a lot of great stuff to say. So that was great. How was the conference for you?
Oh, I thought it was great. That was my first time, and I didn't know what to expect, and it was great. I loved the panel. A lot of great data, a lot of good information. I got very good feedback on all of us. And I think it was a good blend in terms of, what all three of us do for a living and how we approach investing as a whole. So it was really good. And then, the crowds are crazy.
It's amazing. It's a great way to do a conference, for me in shorts and just outside. It was fantastic. Do you spend any time at the booth when you're out there at a conference like that, or is it all meetings and...
It's all meetings, and it's like going from one end of the conference to the other end of the beach, which is also in and of itself amazing. But in doing that, you run into all kinds of people, and people on Wall Street, people that invest, people from, prior lives in terms of where I used to work and that sort of thing. So it was a lot of fun. I actually didn't even get to the booth or any of the booths.
Is that right? Yeah, I spent time at our booth a little bit, but you're right. It was just a long kind of walkway and people just going back and forth. I thought they managed it really well. Great show. So much to cover. And before I forget, let me just introduce you, Stephanie Link.
Oh, sure.
You probably need no introduction, actually, but people that are watching the YouTube video of this, but welcome to Trends with Benefits. I am Ed Lopez, and my guest today, Stephanie Link, and so much, again, to talk about. Thanks again. Let's back up and talk about kind of what happened in April. Was that the whole tariff thing and scared the bejesus out of everybody?
Everybody. Yep, it did. And it was not easy, definitely not, because of all the things that we were talking about. Like, we just didn't know that tariffs, I think everyone thought it was going to be a mild version of tariffs that we were going to put in place around the world. And then it was so much more extreme.
And day after day, like other big announcements came out.
It was huge. And companies, they did freeze a bit, right? Because they didn't know how to deal with their business plans in the face of tariffs. They didn't know what was going to happen with inflation, with costs, and what it meant for demand and all of that. So rightfully so, to be concerned about it. And then you added on the whole geopolitical issues, and that was scary. Mm-hmm. And then it was inflation. Well, sheesh, it doesn't come down. And it's like it's staying elevated, and therefore the Fed is going to keep at a pretty restrictive interest rate policy. So there were all of these things that were concerning. And I will say I had 9% cash in my portfolio in February. And by the end of April, I went to 1% cash.
Huh. What gets you off the sideline? So maybe it's talk to your philosophy a little bit.
Yeah. So, by the way, I was early, right? So in February I was buying, March I was buying, and then April. So I don't want to sound like I knew it was the best time. What I do in my process, and it's always served me well, is I think about themes. So what we just talked about in terms of AI and then the infrastructure piece, right? I think of themes, and that's one of 15 different themes that I have in my portfolio. So I think about themes. And I think about long-term total addressable market. And I think about, well, if I believe in this theme for a decade, nothing of TGIF should impact these themes for the long term. And so then I kind of dig into the fundamentals, and I'm really big on looking at the valuation. So I'm kind of growth at a reasonable price, but it's a reasonable price. I'm stubborn on the valuation piece. And what I do during these uncertain times is, all right, I kind of stress test. Where do I think worst case scenario earnings can go? And if I kind of feel comfortable about the worst case scenario and the valuations still look attractive and I like the management team, then I'll slowly dollar cost average in on the decline. So I'm not going to just totally plow in and buy a full position or add a full position. I'll dollar cost average in because I do this for a living and I can't even do it good for a living. No one really can time, right? So I just try to kind of put the blinders on a little bit. And I'll just go back to one thing I mentioned. Management teams matter. So I only own 30 stocks in my portfolio, and I know every CEO and I know their bench. And I do that on purpose, and no stock will go into my portfolio unless I do know the management team really, really well. And maybe it's just a function of my age, Ed, because I've been around for a long time. So I happen to know a lot of CEOs, but I do think track record, execution, strategy, consistency really do matter. And if you have, like, one of my favorite ways to invest is if you have like a company that has good bones per se, right? They've got the right things put in place to be a success, but for whatever reason, they're not successful. If a new CEO comes in and takes over who has a proven track record, they can absolutely turn that company that had potential, that had the bones to get it going. And perfect example is 5 years ago, I bought GE when Larry Culp joined GE. I mean, it was a $6 stock and it was going bankrupt according to everyone. And I said, not under Larry Culp's reign. Larry was the CEO of Danaher. And if you want to see a pretty little chart, long-term chart, it's Danaher. He really did such an amazing job. And so fast forward to today, and the stock has been an amazing performer. And that's exactly what I look for when I look at various different opportunities. And so in April, it was not easy to be buying. And I had already told you I've been buying for 2 months, and I felt really silly. But I knew for the long term that if I had these themes and I have these great companies and I have these great management teams that have proven that ultimately I would be maybe somewhat right. And so it's not easy. When I'm under my desk, and I'm pushing the buy button, that's a tell. That is a tell that it's like, okay, I'm really scared. I really don't know. And it's like, it is hard to do.
So you start out with themes and then you select the stocks and like, how do you keep it to 30? Is it based on the potential for returns over some period of time or potential for earnings? And you really just have to be diligent about just cutting it off at 30?
It could be 30 to 40, but I know myself and I'm like I'm like a perfectionist. I want to make sure that I have dot every I, cross every T. I have a great staff. I have a great team, but I'm the one that is accountable and I'm the one that makes the decision. And I have to feel good about that. And I just don't think I could have more than 40 max. Because I just think I would be spread too thin. I find it amazing, those people that own 100 or 200 stocks in any given portfolio, and if they can outperform, God bless you.
Yeah.
But I can't do it. And I do have a staff, right? I do have a good team. So I kind of feel like I could really, it's concentrated for sure. So as you would imagine, relative to my benchmark, which is the S&P 500, it's volatile, right? It's like, I'm not just going to beat the benchmark by 5 basis points on any given day, right? It might be 30, it might be 40 on up or down relative, but I'm okay with that because I do feel really strongly in knowing my companies and being able to really analyze them well. And again, by meeting with them and they're not telling me anything that they're not telling the public, of course, but just knowing them, like reading their body language or their tone, it's certainly, you can learn a lot just by watching and listening.
Yeah, that's great. Do you give much weight to earnings calls or earnings transcripts and whatever they say there?
I do. I really do. Especially comparing it to prior quarters. Because if the business is going well, they're happy to talk and answer any questions. When business is not so great, when they have challenges, they still answer questions, and that's, I respect very much. But you can tell, you can see, you can read a bit in terms of the like I say, the tone or just the information. I learn something new every single earnings call. So, that's fun.
Yeah. As a side note, I guess Trump announced on Truth Social this idea of foregoing guidance or quarterly calls.
I know.
Or quarterly reports. Yeah.
I'll tell you, and we talk, like we have a morning meeting every day with my team. And I said, the first thing I said was, what is he talking about? Why? Because the reason why our markets trade at the multiples that they trade at relative to any other country in the world is because of our transparency and the ability to analyze with better precision than others. Like I compare it to, let's say, Europe. So Europe is at 13 times their forward estimates. We're at 22 times. We're not cheap. There's no question about it. But the reason that Europe trades at 13 times is because they aren't as transparent. Some of their companies don't report 4 times a year. They don't go to conferences every month. They don't talk to investors. There's also the fact that their margins, I think, are secularly depressed because of the regulation that is ongoing there. But I think the lack of transparency really makes it hard to go want to buy a whole bunch of European stocks. In addition, same thing with China. You wake up one day, you could do all the work in the world on any company, all the fundamental analysis, and you really like it, and you wake up one day and you got a Jack Ma situation on your hands. Remember when he was at Alibaba? Like, we still don't even know what exactly happened there. So to me, if I want to have exposure to Europe, if I want to have exposure to China, India is a big favorite of mine, own US companies that have exposure in these regions so that the incremental growth that you expect from these countries, it'll be certainly absorbed in the US multinational companies as well.
And you get that transparency as well with that.
You really do. Like, it's hard, it's hard. It's one of the reasons I actually don't own many small cap companies as well. Not that they're bad companies, because they're not. So many of them are amazing. I just think that's another thing. There's not a lot of analyst coverage. They're not at a lot of conferences. So it's a little trickier.
Yeah. On the whole quarterly reports thing, I mean, that idea has kind of been out there for a while, I think. Yeah. And some people talked about kind of a variant of that, where you still have the quarterly reports, but maybe just no guidance. Don't give any guidance. And
I just want information. Yeah, I just want information. Although, again, a lot of it is their body language and their tone.
Yeah.
And so I would miss that. But I understand well, at least why Trump is proposing it. And a lot of it is because of costs. It is very costly to report earnings. I think there's a lot in terms of other things that we can do to help companies. For one, we can make it cheaper to go public, to do an IPO. And I think the SEC is reviewing that right now, as a matter of fact.
Yeah, that'd be great, because I think this year's looking pretty good in terms of IPOs, but it's been tough. More companies are staying private longer.
Yes. Well, and why go public when it's so expensive, and B, you have private equity all over the place.
Yeah.
Right? So we went from 8,000 public companies in 1996 to 4,000 today.
Wow. So
that is one of the reasons why the SEC is thinking about making it a little bit less expensive, less costly to do IPOs. We'll see if they do it, but I know it's on the list, on the agenda for sure.
You mentioned you worry about a lot of things when it comes to the stocks. Well, what do you worry about, or what are you worrying about going into the future here?
Yeah, I mean, I worry about the Fed not getting it right. They don't have the greatest track record. Look, by the way, let me say, I give them an A+++ during COVID. Absolutely. We did everything. Bazooka with the Fed, with the balance sheet, with fiscal policy. We needed it. We needed all of the bazooka because we closed the world down. And so I give them an A++. But then they were very late in terms of starting to raise rates, given the inflationary implications from COVID, from the supply chain issues. And so, the transitory thing really got in the way of them looking at the real numbers and looking at the facts. So fast forward to where we are now, I kind of think they, even Chairman Powell has said, if it wasn't for the tariff issue and unknowns, they would have been cutting by now. Well, that's sort of interesting in and of itself. But for a while, they were worried about tariffs and the inflationary aspect of that. Okay, I understand that, because their dual mandate is inflation and jobs. But just last meeting alone, Powell then shifted and said, oh, we now believe tariffs are going to be a one-time hit in nature, but now we're worried about the labor market slowing. So it's like, what were you waiting for on the tariff side and the inflation side? How did you come to that realization? Because I would even argue that we probably won't feel the full effects of tariffs for another 6 months.
Yeah. So do you think the problem is that they're trying to predict where inflation might go as opposed to just reacting to the numbers in front of them?
They say they're data dependent, so we kind of should take them for their word. Okay, well, the data is showing you've made a lot of progress on inflation, even though it's sticky. Now it's quite obvious that the labor market is definitely slow. I would say the labor market, by the way, it's cooling, not collapsing. But I do think that the Fed should do something. It's definitely more to come. But again, like if we got a bad inflationary report, it would be interesting to see, what they say and how it all evolves. But I think they could. By the way, I don't even think, Ed, that 75 basis points of cuts this year is going to do much.
Oh, yeah?
I really don't. I don't. Although I do think from a sentiment point of view, for sure. And I just looked at, so I'm a big housing bull. I have been for a while, but I was just looking at the 30-year mortgage rates and bank rate. They come out every day. Interest rates, 30-year mortgage was 741 on January 13th of this year, 741. Today they're at 643. So it's not good enough yet. We need under 6, I'm sure, but the pent-up demand is there. And if you start to cut rates, I know everyone says, well, it's not the short end that impacts the mortgage rates, but at the curve, it does matter. And lower Fed funds is going to, I think, kind of ratchet everything down a little bit. And so if we could get housing to recover, because we haven't had housing yet, that would be very stimulative to the economy, I would imagine.
Yeah, I'm looking for that as well, with a couple of rental properties out there. So, I guess one of the worries, maybe also if they lower rates, do you think that influences, some people may worry that the long-term rates would actually go up because of concerns about the deficit and the move away from the dollar and things like that?
I know. Anyway, so I think the long-term rates have more to do with growth than the deficits. We've had huge deficits for over a decade. But on that topic, Ed, it's kind of interesting. I think it was Merrill Lynch over the weekend actually lowered their deficit number expectation because of the tariffs.
Because of the tariffs.
So, here we go. We're worried about the tariffs. It's going to only do bad. And yet we're going to probably see $300 billion this year, and we'll tack that off of the deficits. And I would also say that if you grow above trend, 2.5% GDP, if you get to 3, that's going to help the deficits too. So, and of course, lower interest rates will really help. At least on the interest expense part.
Yeah. Do you worry about Fed independence? That seems to be like the topic du jour in financial media today. Or is there a different way of looking at what's going on and what Trump's trying to do there?
I think that's another worry. So the Fed getting it wrong again worries me, and then compromising the Fed. But I do think it looks like it is already it's already changing. And Powell, I think he has until May, and maybe he's going to leave sooner than that. But it already does appear that you've got quite a few more doves on the Federal Reserve Board in general since, in the last couple of quarters. So, I think I would like for them to stay independent. I think it's very important. But I also think, what does it hurt to have conversations with many people about what to do in terms of interest rates? What does it hurt to and I'm sure they are talking to many, many people. I'm sure they're doing all kinds of research, but they should, and they absolutely should. But the independence thing, it really something that worries me a bit, because you really do want to have, checks and balances.
Yeah, I guess we'll see where that goes. But even if they lower rates, like you said, you don't think that's going to have a major effect on much of anything. Yeah.
But I think on the margin, maybe housing.
Yeah.
Because, we're 5 million homes short in this country. And we have, if you talk to the home builders, they've been underproducing for 15 consecutive years. They would rather buy back their stock than build. So they're being more disciplined. But that means there's such pent up demand. Oh, by the way, and there's 5 million millennials that want to buy a first-time home. So I think there is that pent-up demand should we get rates to come down. And I think we will see that. And then the other interesting thing is, maybe it helps auto sales too.
I was wondering about that. Yeah, that's a sector that's been depressed for a while.
Really depressed. I just bought a company called Aptiv. It's an auto parts company, and it's really a special situation because they're spinning out into two companies, and I love spin outs. And so, but I think lower rates could help. I think expectations are really nowhere. Look, I'm on TV a couple of times a week, and I kind of know like the main topics of what everybody always wants to talk about. And it's always technology, of course. It's always Mag 7. It's always NVIDIA. It is to a certain extent, it's Bitcoin and crypto, but it's not autos. So I kind of like that too. And I think that could be, interesting. There is and I'm sure you know this, there is a multiplier effect to housing, and it does correlate to autos. You buy a home, you got to buy stuff inside the home and outside the home, and you have to buy a car to get from the home to somewhere else. And there is a tight correlation between auto sales and housing. And so to the extent we can get housing to go, then maybe we get autos to go too. But it really is very rate sensitive.
Is there are you familiar with different areas or regions in the country where housing might pop if that happens?
So first and foremost, the high end, they're kind of immune. So Toll Brothers, they have expansion all over the country, but their high end, they are able to produce industry high margins as a result, as you would expect. And their sales have certainly been hit a little bit because of the downdraft, but it's a little more insulated. The real contrarian play would be something like, in full disclosure, I own it, D.R. Horton, because they are about 60% of their book is in the Southeast, Southwest, and there's a lot of supply. Think about Florida, think about Nashville, think about Austin, Tech. There's a lot that has been built over the last several years, and so it's more depressed. But I think if you believe my thought process in first-time buyers, that's 60% of their book, and they should benefit as they see better demand. But again, it really does all depend on the rate environment. These companies are doing best they can in a really challenging environment, and we'll get through it for sure. They'll get through it, and I just think the valuations in the sector are so cheap, and I think these are very well run companies, and this is out of their control. But we'll get that right at some point. And one last thing, I'm not sure we're going to see existing home sales do so well as opposed to new home sales. Because I think existing home sales, we have 90% of people that have a mortgage, it's under 3%. That's a lot.
Yeah, it is.
Why would they sell a 3 and buy a 6, right? They're not. But the first time, the millennials, they don't have a mortgage. So what do they know?
And with all that supply out there, I would want to buy new.
100%, right? I don't know about you, but I got a 6.81 on my first 30-year mortgage way back in the day, and I felt like a rock star.
Yeah. What do you think about, and this is just kind of a random question on this topic, the big box hardware stores like Home Depot or whatever? Because I bought a house a couple of years ago, and I'm still fixing it up. I go there every weekend. I'm like, man, I should have bought that stock.
100%. Look, you're in a duopoly, number one. Number two, if you're not buying a home, you're fixing it up. Yeah. Absolutely, positively. And they, unfortunately, were big beneficiaries during COVID. Big, right? Because think about it. How many home offices needed to be built, and how many home offices needed to be upgraded, and tables and laptops and all kinds of things. They were a huge, huge beneficiary. And so as a result of that, they had really tough comparisons over the past 2 years. And we're now starting to get through those tough comparisons. We're getting more towards normalizing same-store sales. But it was not really ever a traffic problem for them in the last couple of years. It's not really been demand problem. It's just been really tough comparisons, and on the margin, softer than what they had been seeing. And throw on, we've had a disappointing housing cycle. So I think they're primed to do really well. I actually literally just bought a company called QXO, and it is a building products distributor. So it was formed by Brad Jacobs, who is the CEO of the company. And he was at United Rentals and Waste Management. So he's been around. He's got a great, great track record. And anyhow, his whole strategy is just to buy building products for distribution. And I think it's sort of kind of interesting, backdoor way of playing housing, or in general, just construction and building materials.
Kind of change topics a little bit. Let me ask you about small caps, if you have an opinion on that. What's the deal with that? They've been disappointing for so long.
I know. And I think they are. I mean, a lot of people have said, yeah, lower interest rates will certainly help them, obviously, because they have higher debt levels than most Fortune 500 companies. The small cap trade, I think it can make sense if you believe in the economy staying above trend, which, as we've talked about, I do believe to be the case. But you could also own the same factor of owning a small cap stock is owning cyclicals and owning economically sensitive sectors, financials, industrials, materials, discretionary. So if you can play it a couple of different ways in the market. I think personally, the small caps are harder to invest in, only because, again, it's that lack of transparency. It's that lack of support from analysts on the sell side. So there's not a lot of research on these companies. It's just not as much visibility. So I might miss it. I probably will, but I'm going to make up for it with all the other sectors that I'm overweight, because I believe in the same kind of premise, the same theme.
Yeah. As you were talking about that and transparency and availability and analyst coverage, it made me think about, well, the knock-on effect of companies staying private longer. Well, is that, I don't know, maybe I'm trying to compare small cap stocks to private companies, but do you look at private equity in a different way? Do you do any private investing?
We do. So I run what we call our investment solutions team at Hightower, and it's like an internal asset manager. And we offer equity SMAs and fixed income and multi-asset strategies for our advisors, so they can outsource to us if they choose. And we also offer private markets as well. And we've put together, what's kind of fun is so one of my big themes is cybersecurity. In addition to AI, it's cybersecurity. I mean, I think cybersecurity is going to be bigger than AI because of AI. AI is not safe. It's not secure. And when you see something like a Palo Alto buying a CyberArk, they mean business. And I think you're going to see massive consolidation in the industry, because we have 4,000 public and private companies in cybersecurity, and nobody offers 100% solution to any client. And I think the big five are going to get bigger and bigger and bigger, because they want to add capabilities to what they can offer to their clients. CTOs, chief technology officers, they have said, and I talked to a lot of them, they have said, there's two places that we're going to be spending double digit money growth on is AI, because companies are still trying to figure out AI and what it means for their business, and cybersecurity, because they can't afford to wake up and lose their business. So that theme is huge. And I own a couple of names on the public side, but to your question, on the private side and what we do, we actually have a cyber fund, and it was one of our most successful cyber funds, that from a different manager, but we hired the manager and we presented it to our advisors for them to participate. And it was our largest participation rate of all the private deals that we have done. And because it is such a powerful theme. So I love it when public companies and private companies and the themes that we're trying to help with investors. I love it when there's ideas and opportunities in both. And in fact, I own Palo Alto, and Palo Alto, it just made the acquisition of CyberArk, but they also bought a private company that we owned in that fund. So it's like a lot of cross-pollination, if you will, and it's a lot of fun when it all works out.
Yeah, totally. I was just going to talk to you about the data center theme. You've talked about that, some staggering numbers in terms of what needs to happen from a build out. What did you quote? Currently, we have 11,000 data centers. We need 30,000? 30,000
by 2030. We have 5,400 here in the United States. So we're the largest. We clearly are but think about this. I know we talk about tariffs, and I know the whole premise is A, we want more revenue, number one, and B, we want more companies to do business here. Because if you do business here, then you're not going to get tariffed. Okay, makes all sense. We're not going to get 100% of companies to be doing 100% of their business here. It's far too expensive, and it would take years and years. But to the extent we are seeing more and more companies trying to diversify away from China and their supply chains there and this technology, and to the extent that we're helping to fund some companies like Intel in terms of doing business here, I think that we're going to continue to see momentum here, and we're going to see continued growth here. And a lot of that is data center driven, AI driven. I mean, just think about what Mark Zuckerberg is doing. Like,
yeah.
He's paying people $100 million to come and work at his company because they're AI experts. I mean, I don't know about you, Ed. I think we're in the wrong business.
I know I should have continued with that computer science class in school.
That's so funny.
But so like on the data center side, is that a real estate play, like a REIT play? Is it an NVIDIA semiconductor play, or is it a supplier type kind of play?
All of the above. Absolutely all of the above. You can play it anyway. Oh, by the way, utilities, right? I mean, your audience and all of us. I mean, we're going to be in a little bit of a world of hurt because our electric bills are going to go up a lot. I think because they can only go up so much because obviously they're regulated. However, they're going to keep going higher. They just are. The utility companies have been underinvesting for a long time. And not only that, but now they've got to invest even more to upgrade their systems, their facilities as well. So you can play it. Yeah, you can play it REITs. You can where the data centers are housed. You can buy some of the automation companies, like I mentioned, Rockwell Automation, any of the industrial companies, any of the power companies, the independent producers. You could buy something like Nextera. Or you can just call it a day and just say, I'm just going to own NVIDIA and, that's it, which is perfectly fine, too. I think you should own a little bit of everything. And because it is a theme that I don't believe we're in a bubble. Not when you have the four largest Mag 7 companies spending $400 billion this year alone. And the numbers keep going higher and higher. These are brilliant people.
Yeah.
And they're all spending. And so next year, is it going to be the same amount? No, it's probably not. But it's still going to be growth.
On a topic like this, that's so hot and there's such potential. I think you can make a great case for it for the long term.
Yeah.
Do you just throw valuations out the window and go, we need to be in this, whatever it is, and just track momentum? And whenever that starts to taper off, then you maybe take some money off the table?
Well, because I don't think you can say any of the stocks that I've mentioned or any of the sectors are cheap. Utilities are cheap, but they're cheap. They're always cheap, right? They just have a lot lower growth profile to them. I think it's like you got to look at where you think the total addressable market, where it's going. And you have to ask I believe we're not in a bubble, but you may think we are in a bubble, or other people might think that. You have to feel comfortable with where you think the overall investments are going. And that's why I think you have to have exposure to the Mag 7. I don't know if you have to own all of them, but I think based on where I'm more comfortable is, and the reason I mentioned the industrial companies, the way to play it, is because I look at their book to bill. It's as simple as that. Book to bill, backlog, and what does it mean? And the companies that I've mentioned all have a book to bill north of 1. And Eaton also has this one stat. This is crazy. There are $2.7 trillion worth of mega projects out there in the world today. Only 15% have been completed.
Wow.
So let's just say that number, cut that number in half, because maybe we're really wrong. But that's still an enormous growth. So those are the kinds of things I'm watching. And we kind of have to be, a little bit willing to be flexible on the valuation side, which I hate to do because I am really valuation centric, but I do not want to miss one of the best themes of our lifetime.
Yeah. Yeah. You have to be somewhat valuation centric within a theme. Like if you have a 30 or 40 stock portfolio, you've got to pick your best picks for that theme, right?
Yes, absolutely. Okay. I mean, it's hard. Sometimes it's like, and guess what? Sometimes the valuation is appropriate. Like,
Yeah.
like why let me go back to cyber for a sec. Why does Palo Alto trade at 14 times price to sales when CrowdStrike trades at 30 times price to sales? Because CrowdStrike is the number one player with the number one management team, although Palo Alto is right there with them. I think that's unjustified. But others might think, hey, CrowdStrike is just twice as good a company with twice as good of fundamentals. I'm not in that camp, but obviously there are people out there because they're paying it.
So as we look towards the end of 2025, what are you leaning into for this last part of the year outside of AI?
Yeah, I mean, I think that a couple of things. And first, I think that I'm surprised, by the way, that so far September hasn't been more volatile. September is usually the worst month of the year. On average, it's down 2% for the S&P. So I feel good about it. I was expecting to see a little volatility. We're not seeing it yet, but you never know. But I think the setup into the fourth quarter is a good one. I think the fundamentals remain very strong in the economy, in earnings. And yeah, we do have some great themes that I think will continue to work. I think you have a lot of portfolio managers that are behind their benchmarks. So I think you're going to see a bit of chasing. I think you have $7 trillion in money market funds on the sidelines. I don't anticipate all that money coming in, but there is money to come in if people want to do so. And the most important thing is that credit spreads are very tight.
Yeah.
So if we were about to go into some panic mode, watch credit spreads. And so they're tight, and that's positive for risk on assets. So overweight financials, we just had the Barclays conference last week, and every bank executive said the consumer remains strong, that credit remains good, and demand is there. And so I like the banks a lot. I love this new combination company, Capital One Discover Financial. I think it's transformational for Capital One. So I like that as well. I still think that the industrial complex will do well. So we talked about the AI part of it. I like aviation a lot. When we started January of this year, for the beginning of this year, I said Boeing was my favorite stock. It remains my favorite stock. It's been a very hard time for the company over the last several years. We know why, but they have a new CEO, Kelly Ortberg, who has a tremendous track record at Rockwell Collins. And you have a duopoly with Airbus. They have 13,000, both of them have 13,000 planes in their backlog. That's over 7 years plus each. So the visibility is there. With Boeing, it was never a demand problem. It was obviously a safety problem. And they got all caught up in the government as well. Kelly Ortberg has done a great job in terms of changing and fixing that culture. And so I think aviation is certainly one that makes a lot of sense. I'll put my Peter Lynch hat on for you, and I'll give you my next theme is animal health. Because I own 3 animals, and I spend more on my 3 animals than I do my 18-year-old. I'm not even kidding. I mean,
dogs, cats, everything.
2 cats, 1 dog, and my 18-year-old just went to college, so I have to get another dog because I'm so super sad.
Yeah.
So, do you own pets?
I do. I have a beautiful little mix, a Labradoodle Pomsky mix.
Oh, that's really unique, huh?
Yeah, she is. Oh. She's an accident, but she's a happy accident.
And you would do anything for her,
absolutely,
right?
Yeah.
Of course. And so we're going to spend $150 billion by 2030 on this industry, on animal health and wellness. 7 out of 10 people in this country have a pet.
Yeah. So,
and I know we all got a little bit more pets maybe during COVID, but we're stuck with them, and it's alive and well. And they're really only 3 companies. It's Zoetis, Elanco, and IDEXX. Maybe you can throw in Merck, but they're big, but it's just not a big part of the business. So Elanco quietly is up 50% year to date.
Amazing.
It's crazy. That's a turnaround story. Zoetis is the leader. IDEXX is somewhere in the middle. So I really like that. And then I would say the last one that won't surprise you is ride sharing. I think that the total addressable market, certainly, I mean, you talk to the CEO of Uber, he'll say that the ultimate global total addressable market is $5 trillion between now and 2050. Who knows? But I think it's at least $100 billion by the end of the decade. And Uber is a verb. And I've learned when there's a verb, you buy the stock.
Oh, yeah.
Right? I mean, it's true. Well, we do Google. We say, hey, go Google it. You don't say, I'm going to go look at my search bar.
Right.
So I have found that, Uber. In fact, I say I'm going to Uber, and I actually use Lyft, which is funny. I don't know why, but anyhow.
It's become the brand for everything, kind of like Kleenex. It's
yes.
You don't ask for a tissue, you just ask for a Kleenex.
Exactly right. And that's my point. But most importantly, the growth is there. The market growth is there. They dominate the industry. They've got new products. They're getting into different end markets. What did I read the other day? That they have announced a relationship with Sephora so that you can get makeup in 20 minutes. I'm not really sure I need makeup in 20 minutes, Ed. Not there, but you can apparently. But they're trying a lot of different things, and that's what I like. And I think he is really the industry best. And wow. I do think, by the way, in autonomous vehicles, I know people worry that will put pressure on. I think the both can coexist. I think the markets are big enough, and I like the partnerships that they are doing with autonomous vehicles like Waymo.
Yeah. Have you ridden in one of those?
I have not. Have you?
Yeah, in Austin.
Really?
It was great. It was it was a better driver than most of the other drivers out there.
Well, that's a good point. Were you scared at all?
No, we stayed in the city, and it was maybe not higher than 30 miles per hour. So it was great.
Okay, good.
Yeah.
Oh, good. Yeah, that I wouldn't have a problem with. Maybe getting on a highway, I don't know. But
yeah.
It is the wave of the future. Right? I mean, it may not be this year. It may not be even in 3 to 5 years. But in 10 years, they will make massive progress on it. And and here's the thing. I worry because when I'm late to something, I tend to have a heavy foot on the gas pedal. I don't think you're going to be able to be late to anything with Waymo because they're going to go speed limit.
All right, totally. You're just going to be late.
You're just going to be late. That's right.
Yeah, big fan of those.
That's interesting. That's cool.
So, and we talked about a lot of different themes and ideas, and let me see if I can get you to just highlight one big idea or trend you see playing out over the next several years. And really, that's a question for my guest to go beyond what we talked about, really.
Yeah.
But you can. But just kind of curious if anything funky's out there that's like you're watching.
Yeah, but I don't have a way for you to play it. I want to just bring it to your attention and to your audience attention. It's women. There's about $40 trillion of money that's going to come into women, whether it's inheritance, whether they sell a business, whether they get divorced, whatever, between now and 2050. $40 trillion of wealth that they're going to amass. That is huge. Women are getting more sophisticated. They're going to college. They're going to advanced colleges. They're going into the workforce more. We have about 25% of women that are C-suite women, and that was up from 17% a decade ago. And by the way, this is an interesting stat, and I didn't know it, but 1977 was the first time a woman could have her name on a credit card by herself.
Oh, really?
1977, that's not that long ago.
Yeah.
No? I mean, if you think about it. So point being is we're getting more sophisticated, and 94% of women want a woman advisor. So I say this only because that's a niche, and that's something that, maybe it's a nice growing niche. I don't think it's being addressed. And so I think that's something. I will say women are spending more on luxury homes. They're spending more on luxury items. According to De Beers, 30% of women bought themselves diamonds last year, which I'm one of them. I have a husband, but I bought myself a diamond. And the WNBA is one of the most popular brands in sports today.
Wow.
And so it's great. So I'm not sure how you invest in it, to be honest with you. You can go buy a WNBA team. I don't have that kind of money. My point being is there's a lot of ways to maybe play it.
Yeah, I think for a financial advisor, like you said, is a way to look at their practice and see if there's another market they could be tapping into and
for sure.
out.
And there's this one other thing that private markets have been buying. It's something called Femtech. So it's technology, healthcare technology based on women, based on female women and their diseases and sicknesses. So think of osteoporosis, think of pregnancy, that kind of thing, ovarian cancer. So you think of that there's not any public companies, unfortunately. I wish I had them for you, but private companies have been buying these companies. So they obviously see value as well. So So stay tuned. Maybe we'll have a couple of public names for you next time.
I'm looking forward to the day where AI and there's an app and I can like plug myself into an AI module and it'll just tell me what's wrong with me.
Right?
Kind of like a card,
100%. I totally agree with you. There's so much friction between, the doctors and the labs and knowledge.
Try to get an appointment with a doctor. It's 6 months.
Oh, I know. I know. It's absolutely crazy. So I think we'll get there eventually. Yeah. So that's kind of I think we have a long way to go with that last theme though.
Excellent. All right. You ready for trend or fad, our speed round?
Let's go.
I wrote this down while we were talking, and then I realized we talked about it, but let's hammer it home. Driverless cars, trend or fad?
Big positive. 2 thumbs up.
How about AI-powered stock picking, trend or fad?
Trend.
Meme stock comeback, or the retail investor, I should say, trend or fad?
Retail investor, definitely trend.
Digital asset treasury companies, trend or fad? Trend. You think more companies are going to do that? Like Pantera just went out today with a Solana company, and then you got MicroStrategy out there and others doing that.
I think Bitcoin, if you believe that it could get close to gold's market cap, that would equate to $700,000 for Bitcoin.
Huh. Wow.
And that has massive impact for everybody else. I don't own Bitcoin, and if I could, I would own an exchange like a Coinbase, Robinhood, because you don't need to know what the price of Bitcoin is going to be. You just need to know there's a buyer and a seller. But I think this is definitely a trend for sure.
How about private credit, trend or fad?
Yeah, definitely not trend. I'm nervous about private credit.
Yeah. Okay. That's one thing you worry about. Okay.
I do.
And finally, and you mentioned it before, so I know the answer, but I'm a big bull too. India, trend or fad?
Oh, big trend. Big trend. My favorite place to invest outside of the U.S.
Is that right? Okay. Interesting. So, well, great. Stephanie, thank you so much for your time and insights. This was fun.
A lot of fun. It was my pleasure. Thank you so much for having me.
And what's the best way for people to, they can turn on the TV, but the best way to learn more about you, learn more about Hightower, and perhaps follow you?
Well, I'm on LinkedIn and I'm also on Twitter, and we try to put out a lot of content on LinkedIn, and I do my own tweets. So sometimes they're fun. Sometimes I do a favorite song every Friday night or afternoon. Yeah. And, but I also try to provide a lot of information, just stuff that's going on in the markets, because I think hopefully it helps. Yeah,
that's great. I find it so hard to tweet for some reason. I struggle over every one of them, and it takes so much time.
I know. You either have to just go with the flow and just do it.
Yeah.
And by the way, you have to, for me anyway, I only allow people that are following me to respond, because not everyone is really nice on Twitter.
Yeah.
And so I'm okay with the criticism, but I like to keep it kind of at the high level.
Absolutely. Well, great. Well, thank you very much.
Thanks again. Great to meet you.
And thank you for tuning in to another episode of Trends with Benefits.